Jeffrey, this is the second longest bull market in history. When is it going to end?
Good question. If I knew the answer to that, I'd be on a beach somewhere with a margarita right now.
For sure.
But I do believe that this is going to be the longest economic expansion in U.S. history, surpassing the 1990s. And believe it or not, if we get to July of next year, this will be the longest. And if you think about how much central bank accommodation we've seen, the Fed's not too tight. You're seeing negative interest rates over in Europe and Japan, still doing QE programs. And the fact that fiscal stimulus is just starting to enter into the economy, I do believe that this will be the longest on record. But if you think about how different this cycle is, right? Everybody says it feels different. It just seems like a different animal. They're absolutely right on that, because if you look at this cycle versus the 7 previous, although it's been a long cycle, we actually haven't grown enough as much as the 7 previous economic cycles yet, even though we're in the 10th year of this bull market. So slow growth cuts 2 ways. The downside is people are frustrated. Businesses and consumers haven't felt like this has been a recovery. But the upside is that if there's no boom, there doesn't necessarily have to be that corresponding bust that goes along with it. So long answer to your question, but I do think that this will be the longest on record.
Big picture, and where are you seeing some opportunities?
I think the market right now is having a bit of a tug of war between the short-term negative stories, the fears of trade wars, a hawkish Fed, higher inflation, and the longer-term positive fundamental story of better earnings, better revenue growth, and also better global growth. So I think that this is just a correction at the end of the day. And we looked at the last 11 non-recessionary corrections going all the way back to the mid-1970s. And typically, to see a durable bottom and for the markets to move higher, you need to make progress on 3 fronts. You need to make progress from a price perspective, time, and also sentiment. So we hit the price perspective very early on in this correction. We were negative 10% about 2 weeks into it. But also, you needed a little bit more time to evolve. So the average length of a non-recessionary correction has been about 70 trading days, and we're about 85 days in. But the last area that I think we needed to see a lot of momentum change in is sentiment. And it takes a little bit of time to convert optimism to pessimism. But one good way to gauge sentiment is the investor intelligence bull-bear ratio. And in mid-January, it hit 5.3 bulls for every 1 bear. It was the highest level that we've seen in over 30 years, and anything over 3 is considered a lot of optimism. So if you look at mid-May, that bull-bear ratio was 2.4. So we've seen progress on all 3 of these fronts, and I think that the market's going to continue to melt higher over the course of this year and kind of ride that wall of worry like you traditionally see. A lot of people feel like this is a higher volatility type of period. It's just that 2017 was the aberration. And usually as the economic cycle ages, and we're in the late stages of this economic cycle, volatility tends to go up. But the key point that a lot of viewers should take away is that you don't want to be out of the market, because if at every bull market since 1975, the average return that you've had in that last year of that bull market was 22.6%. So higher volatility doesn't necessarily equate to bad equity returns. And I would just say if you think about periods where volatility picks up, it's late cycle or during pretty big drawdowns or recessions. And study after study shows that active managers create their most alpha during these periods of late cycle or big market drawdowns. So volatility is very much an active manager's friend.
Jeffrey, let me go back to you, though, with this question. With the rise of index funds and ETPs, can you still get exposure with stock picking?
You can. A lot of the strategies at Clearbridge are what we call high active share, which means that we don't want to look like the benchmark. We want to take differentiated bets. Right. And a lot of studies that have come out have shown that these are the types of managers that create outperformance. But we're also doing a lot of things from a risk management perspective. So one unique thing that Clearbridge is doing is that we're looking at crowding. So we're looking at stocks that are out there, look at their exposure in different indices, ETFs, ETNs, investor holdings. And for those stocks that are held by a lot of individuals or indices, we're going to look at that as an increased risk factor. Because if you think about it, it's really good on the way up because you have that positive feedback loop, where as more people buy these indices, the value of that stock goes up, and it's a self-fulfilling prophecy. But when you eventually do have volatility in a downturn, that positive momentum will turn into a negative feedback loop, and it's going to hurt you in an outsized. It's going to hurt you from an outsized perspective on the way down. So we think obviously high active share, but also looking out for over-owned stocks, quite frankly, is the way to be able to differentiate yourself.
Okay, Jeffrey, do you want to chime in on that one at all?
No, I think it just creates opportunities, obviously, for the patient long-term investor that knows their stocks and knows what the intrinsic value is. Volatility obviously creates pockets of opportunity to deploy cash and add low-cost basis stock to your portfolio. The areas that we see opportunity in for the remainder of 2018, it's not really a growth or value conversation from our perspective. It's really a cyclicals versus defensives. So we believe that energy, IT, financials, and specifically banks are very poised to outperform. But we think a lot of the areas that investors have gone to as bond proxies, as a yield surrogate, if you will, telecoms, utilities, consumer staples are going to have a tough time because we do think that rates are going to continue to rise with the increase of growth that we're going to see from tax reform. But to Malcolm's point, I do think small cap represents a very nice opportunity right now because they're the biggest beneficiaries of deregulation and tax reform. And let's not forget that they're relatively immune to trade wars. So that's going to be something that doesn't negatively affect their valuations.
Right. Jeffrey, have you found it difficult to explain your process and remain relevant in a market where growth investing has outperformed for so long?
Well, Clearbridge has the luxury of having both value and growth managers, so we do have the best of both worlds. But as I mentioned earlier, with cyclicals, in our view, being the ones that are going to outperform over the next couple of years, if you think about the largest component of the Russell 1000 value, it's financials. It's about 30% of that index. Think about the largest component of growth, it's IT, which is close to 30% of that index as well. So I think it's really going to be much more of a balanced performance profile versus it's either growth outperforming by a lot or value outperforming by a lot that we've seen since 2016. But again, at value, you tend to see this very cyclical changes happen in the economy with a growth pickup, and with tax reform moving through the economy, and policy has a very long lag time of about 1 to 2 years. A lot of these value companies could get a boost as economic growth increases.
With the economic expansion nearing a record length, what are Clearbridge's indicators signaling about the possibility of a recession?
Yeah, so we've come out with the Clearbridge Recession Dashboard, a group of 12 variables that have done a very good job of foreshadowing an upcoming recession. And the reason why we've done this is we found that recessions usually go on at the same time as big market crashes. There's big drawdowns that scare people out of their asset allocations. And if you look at the 12 indicators right now, 11 of them are green, 1 of them is yellow, 0 are red. So it's a stoplight analogy, which tells us, even though this has been a very long economic cycle, that we do still have some time left over the next year or two. But we looked at the dashboard versus the last 7 recessions. And as you can see, going into each one of those 7 recessions, you see a lot of red, a little bit of yellow, no green, which gives us that confidence that things are on solid footings. But one of the questions I usually get from the investors that we talk to is, isn't the market a leading mechanism? Meaning it'll peak before you go into a recession. So what good is this dashboard if the market's already peaked and gone down 20%, but your dashboard's saying that the economic clouds are starting to gather? So we looked at the dashboard versus market peaks. And on average, the dashboard turned yellow right before market peak. And on average, it turned red right before the market peak. But the key takeaway is that whether it turned yellow or red, it saved your portfolio over 20% from the eventual trough that the recession would bring up. So it can be a very good tool to either de-risk or re-risk your portfolio. And given the fact that we have 11 green and 1 yellow right now, we think that it certainly makes sense to take risk, at least in your equities.
Absolutely. No, that's very interesting. Tax reform has increased already generous corporate cash levels. How are buybacks a good use of that cash and a catalyst for future stock gain?
Yeah, so share buybacks get a bad rap this cycle. Coming out of the great financial crisis, corporations had a lot of cash, but they just didn't have the demand there. So they used it for share buybacks. And I think the chart that we have up there shows you how powerful share buybacks can be. You can see that the red line at the top is the S&P 500. Below it, share buybacks and dividends. And you can see they're almost mirror images of one another. Just to put in perspective how powerful share buybacks can be, in 2016, all of the money that went into active and passive equities was $175 billion. All the share buybacks done by corporations was $550 billion. 175 versus 550, that means corporations were over 3 times the size of buyers of equities than all investors combined. Now, one of the biggest fears that we had coming into 2018 was that if we didn't get tax reform, maybe share buybacks would go down aggressively and that biggest buyer of equities would be exiting. But with tax reform, you have repatriation of overseas earnings, about $1.2 trillion coming back home, which means there's a lot of ammunition to be put to work in share buybacks. And if you look at a lot of estimates right now, they think about $800 billion worth of share buybacks are going to take place this year, making it the largest on record. So that put or that floor that we've seen in the market is still very much there.
Jeffrey, you want to follow up with that with anything?
I would just take a different vantage point, saying that if you look at the after-tax cost of borrowing of a company, and if it's way lower than what the earnings yield of your stock is, so instead of a PE of the stock, you would just flip them around and put the E on top of the P, way of converting a stock into a bond. If there's a big distortion there where the earnings yield of the stock is much higher than your after-tax cost of borrowing, I think that makes sense to do share buybacks because the market, and the bond market specifically, is signaling that your company's cheap.
Jeffrey, coming back to you, what sectors or geographics are you using to find the opportunities?
Yeah, so we're really excited about energy right now. We think energy is poised to be an outperformer for a number of different reasons. First and foremost, valuations. So you've seen this huge increase in the price of a barrel of oil. Oil's up about 145% from its lows, but energy stocks have lagged significantly. So the E&P companies have only got about half of that gain. The services have only seen 1/7 of that gain. So I think there's a little bit of catch up to do as far as valuation is concerned. But also, if you look at every economic cycle going back to the 1960s, energy has historically outperformed in each and every one of those last parts of that economic cycle, which I believe we're in. So we like energy from a valuation perspective, but you also have very firm demand. Demand was just upgraded here recently by the EIA. I think there's a very complacent view on supply, that the American shale revolution can continue to bring on barrels as quick as they have, but you're already starting to see some supply disruptions in places like the Permian where they're able to drill it, they're able to bring it out of the well, but they're not able to actually transport it for physical delivery. But last but not least, I think you need to talk about the geopolitical risks that are potentially out there right now. And in the Middle East, you can look at Saudi Arabia, Iran, the issue with Israel, Syria, Iraq. There's a number of issues that could potentially crop up here where a barrel of oil could go up significantly from here. So in energy, I think there's a lot of ways that you win and not that many ways that you lose.
Okay. Jeffrey, anything you're avoiding? You told us what you talked about energy. Anything else and anything you're avoiding?
Yeah, I would probably echo Malcolm's comments about the rate-sensitive areas of the economy. They've obviously been the biggest beneficiaries of QE and extraordinary monetary policy, bringing rates down to where they are. Now that we're reversing that, we're doing balance sheet normalization. You're seeing rates go higher from here, and I think rates will continue to move into the threes over the course of this year. I think a lot of those areas of the market that don't have growth and we're just bond surrogates are going to have a very difficult time keeping up with the market, broadly speaking.
Jeffrey, I saw you nodding along as well.
Yeah, I just think the initial move that you saw in Q4 of last year and then January, that was the first order effect, meaning that the market's rewarding those companies paying the highest effective tax rates. I think obviously you need to look at the second order effects and see what are they going to do with that money. Are they going to keep their margins? Are they going to spend it on CapEx, which the markets will generally look at as negative? Or are they in a very competitive industry where other people other companies that have gotten that tax break are going to lower their prices in an attempt to get market share? And those industries that are competitive, I don't think the market is going to reward them as much as some of these other areas that are maybe duopolies or oligopolies, a little bit less competition. But I think a key point from John is that these earnings that we've seen this last quarter, it wasn't just tax reform. It was on better organic growth and a better top-line revenue growth, which has been the hardest thing to achieve this entire cycle. If you think about the stimulus coming into the economy, though, even if every tariff that's been discussed goes into effect, it's about $100 billion in total. Just the tax cuts to individuals this year will be $200 billion alone, plus another $500 billion in repatriated money. I think trade wars obviously gathers a lot of headlines, but I think just given where we are with stimulus coming into the economy, and if you look at a history of trade wars and Section 301 investigations, most of them never actually lead to actual tariffs. It's just a way to leverage a better negotiation position. If you take that all into consideration, I think that the markets will likely move higher and look through that as time goes on.
Importance of international exposure.
I just think that if you look at U.S. versus the international space, usually one outperforms the other for a very long period of time, anywhere from 3 to 10 years. The U.S. has been outperforming for quite some time, ever since 2009, really. So given the fact that most places around the globe are earlier in their economic cycle, earlier in their monetary policy cycle, they have just more absolute growth to go and valuations are lower, I think it makes sense to have exposure to both the U.S. and the international space right now.
Excellent. Jeffrey, I'm going to come to you first. Why now do you have an advantage, and what factors are leading to your competitive edge?
Well, I think it's a number of different things. I think John hit on two of the things that make Clearbridge different versus other active money managers that are out there. We're high active share on a lot of our strategies, so we do want to look differentiated from the benchmark. But also we do have that longer term hold period. So depending on which strategy that you're looking at, our turnover is anywhere from 60 to 80% lower than the category average. So we very much want to be owners of companies rather than renters. But also with Clearbridge, if you look at our portfolio management teams, the average length of time that they've been in the industry has been 26 years, but 18 of those years have been with Clearbridge. So when you're putting your money to work with us, there's a good chance 1, 3, 5, 10 years out, that you still have the same team, the same process, and the same philosophy or consistency behind it.
Let's come to our final thoughts. We'll go down the line. Jeffrey, I'll start with you. Final thoughts for today from our fantastic conversation.
I think the market's obviously been in a sideways trading pattern since January. A lot of that was after a very, very nice run from the beginning of 2016. I think we're getting through that consolidation phase where the market will start focusing on those longer term fundamentals. Earnings are great, revenues are accelerating. It's just not tax reform that pushed the market up last year and in the early part of this year. So we think the market is poised to rise.